All right, it is that time. I like to start at 6 o'clock. Guess people may be coming. What's that? Wow. Wow. I see what kind of night it is. I hope I don't have any math errors tonight. This could be ugly.
You give me about starting at 6:10 or 6:05. It's 6:04.
But then you...
Latest start ever.
It probably is the latest start ever for me. But then you like go to like 9:30 with your classes sometimes. You try to teach. You try to teach 2 classes in one night. We should have a vote on that at some point. All right. On that note, I am James Orr, Realtor at James Orr Real Estate Services. Tonight we're going over the impact of property management fees on your rental portfolio. So upcoming classes, while some people kind of straggle in, we'll go over that. So Brian, looks like Brian's teaching everything for the next couple weeks. Brian next week is teaching what? Tenant screening overview workshop. We've got the microphone, which everyone insists that we have and then complains that we need to actually hold it now to answer questions. But everyone who listens to it's on, I think.
Tenant screening workshop is basically the follow-on class to 2 weeks ago. I taught tenant screening, and this is the workshop version of that class where you actually get to screen tenants in class that are real tenants, obviously scrubbed so you can't tell who they are. But you get to practice a couple of times of actually walking through the process of screening tenants, and then we'll talk about, hey, what actually happened in this scenario and what I did and what you might have chosen to do. So it should be a great class.
And so the idea is that, whenever we do tenant screening or deal analysis or stuff like that, people sit in class and they bob their head like they know exactly what's going on, and then when they go sit down to do it themselves, they're totally confused. And so this is sort of like the in-between step of, we'll teach you how to do it, and then you go home and do it by yourself. You get to do it with us in public and then struggle through what the challenges are. That way you've at least done it once before you go back to your house.
And you do not need to have come to the previous class.
Although you can watch the video.
Yes, watch the video before you come. That will be helpful.
Because then you'll have heard some of the stuff twice, the most important stuff twice. So awesome. So that's tenant screening. That's next Wednesday, April 4th. And then someone's birthday and a networking party on the 11th. What is that?
I don't know, but we need to find out where we're going tonight after class to decide.
I assume that it was going to be the new place.
Yeah, we will need to talk to them.
Okay. So apparently it's going to be Brian's birthday party, and then we're going to do some real estate networking. So as promised in my email, let's talk about what you get for the guy who already has everything.
Nothing.
And the answer is you can buy him a beer. And if you buy him a beer, he will answer any question you have about anything ever, except things related to James. He cannot answer.
That is not, you heard him, he paused. There was a period at the end of that sentence.
So if you have any real estate questions, a beer is basically the fee in order to get any question answered. And we're going to tell you exactly where it is. It'll be on the meetup for where you want to go. But we have a feeling it will not be at Ryan's this year. It's my guess.
We don't know.
It's my guess, so. All right, cool. So that's going to be April 11th, 2 weeks. And then Brian keeps teaching, because I have no responsibilities here whatsoever. Property Management Mastery on April 18th. What's that one about?
That's basically how to manage your property manager. So.
Oh, is that what that is?
I think so.
I thought that was different.
It's not that managing your property manager. It's just, oh, you're right. This is property management yourself, mastering that.
Yeah, it's like what you do once the tenant's in there is what I thought that one was.
Yes, that is correct.
Okay.
Yes, there are actually like 3 or 4 property management classes, which is why it's confusing, because there's
really
one on property managing yourself, which is what this is. There's one on selecting your property manager, and then there's one on managing your actual property manager. This is not property manager. This is property management on your own.
Yes, that's correct. Okay. And then because Brian's been doing such a great job, we're going to have him the next week as well. So solving tenant challenges on April 25th. Brian, what is that one about? I really have no responsibility for April at all.
Yeah, so that is basically any problem that you can run into, and I'd encourage you to think about problems you have with your own tenants and bring them to class, and we will discuss them. But I have a long list of stuff of, what to do and how to handle it if your tenant doesn't pay rent. What to do if, they're making too much noise and the neighbors are complaining. What to do in all of those circumstances. So figure out what your challenges are. I will walk through a ton of them, but if you guys have your own challenges, we will cover those as a priority.
Awesome. Thank you for doing that. And then apparently I do come back to teach one class. So last week I taught your second nomad property, which is everything you need to know once you're moving out of the first property and converting that to a rental and then buying your next one. Your third nomad property is when you're buying your third property, you've got one that was a rental that you're probably going to have a tenant turnover and all the stuff that's related to that. That is this upcoming class on May 2nd. It is the first time we've ever taught that class. It is going to be amazing. So you will really, really like that class. How many people liked your second? How many people came to your second Nomad class? Was that any good? There's only like 2 people that came? You listened to the podcast? Okay. You have no excuse? That is not a valid excuse. You have to make up the work you miss when you get to take off from school. Okay. What do you mean? I listened to the one. I listened to the one when I was out of town. Yeah, I listened to you making fun of me from the front of the room when I wasn't there to protect myself. Yeah. So your third Nomad property, that's going to be on May 2nd. It is really, really good stuff. Basically, it's all the stuff about tenant turnover and some stuff about emergency planning, but it's the things you need now that your tenant's been in the property for a year. It's like that second part of it. And then I'll also go over the math of what it looks like if you stop at 2 or when you continue at 3 or if you continue for the whole thing. So it's going to have some really, really good stuff in there. All right, so introductions. So we've got the microphone. Brian's going to be mic guy, I guess, tonight. Who are you and why would you consider hiring a property manager? I guess Christoph is going to start.
Yeah, Christophe Ettard. Well, I already have a property manager, so the reason I did it is because I have properties in IRA and I cannot manage them myself, so that's why I did it.
Okay,
Local
awesome.
property here.
Very cool. Thank you. Welcome. And I convinced Christoph to come. He wasn't going to come, and then I sent out that crazy email, and he decided, wow, I need to come to this class. James really oversold it. So now I got to make sure it's good and there's no math errors and stuff, which is hard to do. So.
Hi, I'm Caroline. I do have a property manager in California on a property that I own, and I have one because I am an absentee owner.
Okay, like a long distance.
Long distance, yeah.
Okay, awesome.
Yep.
Very cool. Welcome.
Hi, I'm John, and I'm the same way. I've got property in a couple different states that I can't manage personally, but I am in the market right now to replace a property management company, so that's why I'm here.
Okay, so I'll comment on the replacing the property management company. That's not this class. Yep. This class is on the fees, but there is a really good 2-hour and 15-minute or so class on selecting and managing a property manager where we went over that whole selection process.
Yep. And this is my wife, Bella. She's here with me.
Oh, very cool. Thanks.
I'm Munir, and I would consider hiring a property manager when it becomes too difficult to do it all yourself.
Okay, that makes sense. Thank you. Welcome.
I'm Denise, and yes, it's too difficult to do it all myself.
It's too difficult already, so you should hire one?
We should. Plus I'm a soft touch, so I
Yes.
get myself in trouble that way.
You need to have the enforcer sitting next to you, Munir, actually do your property management. You got to send them out there and say, hey, your rent's 15 minutes past due. Where's your rent?
I'm Curtis. I would hire a property manager to free up my time to continue looking for other properties.
Nice. Good answer. Well, they assume that everyone knows who you are already.
I'm Miles. I have considered hiring a property manager. I've got a couple properties out of state, so it just absolutely makes sense for me.
Okay, awesome. Thanks.
I'm Sabra, and I plan on having too many properties to manage by myself, so
Okay.
in-state or out-of-state.
Awesome. Thank you. Welcome.
Okay, hey, I'm Scott again. This is not really a mic, this is a recording, right?
It is a recording mic.
All right.
It doesn't amplify you, but it does record.
Hey, so in the past years, I've chosen not to have a property manager because I've used that money to kind of fix my properties up.
Yep.
But now that they're all kind of stabilized and everything, I certainly see the value in a property manager is just to be able to minimize that effort and to free your time up, like Curtis is saying, to go out and do something else. We were just talking about it at dinner tonight. And at that point, you just get a check when net cash at the end. It's all over, and someone else is taking care of everything. You see whether it's worth the money or not. What is it, 10% normally?
We'll talk about that.
All right. That's the fees part. That's why we're
Yeah,
here.
we're going to talk about fees.
All right.
Nick. I think the same thing like they were saying. Once it becomes unmanageable for a single person to do, your time, gotta figure out what your time is worth.
Yep. Awesome. Thanks.
I'm Tammy, and I'm going to go with the same. I think it comes down to a matter of time.
Awesome. Thank you. Welcome, Tammy. Thanks for coming tonight. It's good to see you. What's that? Are you a matchmaker?
Hi guys, Tyler King, First Class. I'm a multifamily broker. I sell apartment buildings, and apartment and property management is kind of a whole different animal, right? But personally, I have single family portfolio, and I've strongly considered, they're out of state. I've considered hiring a management company. I've never done it, but it's something that I've definitely considered.
Awesome, cool, thanks, welcome.
Hi, I'm Alex, and I'd look to hire a property manager if, like most people have said, if you're location-wise, if you're out of state or, you know, not able to get to them, or if you have too many to manage and if it's financially feasible as well. So.
Okay, awesome, thanks. Oh, okay.
My name is Caroline, and I would hire a property manager. I have a number of properties locally that I manage my own properties, but I have a property that I just inherited from a parent who I'm in a ownership with 2 siblings, and I would really trust a property manager.
What's the difference between one of your siblings? You just
I would not trust them to make decisions
Oh,
on the
okay.
property or
That makes
to
sense.
actually, you know, take care of what needed to be taken care of. Like the roof is caving in. Oh, should we do something?
Mom and Dad were living in a house where the roof was caving in?
Well, it's been sat. My siblings sat on it for a year before they decided maybe we should do something. It's for family. Maybe we should get renters. So, yeah, property managers might be good.
That's probably a good idea. Awesome, thanks.
I'm Joe. I would have to agree with Munir and Tammy and a few others that it boils down to time. I think once you get to that point where you can't manage it yourself, then it's time to bring on a team.
Yeah, I can see that. Awesome, thanks.
So I'm Sean, and I would hire a property manager when I realize my dream of buying a sailboat and sail around the world, because I won't be able to do it at that point.
That's the only time you want to do it? That's awesome. And you want to give it to Sai in the back, too.
Hi, I'm Allison. Technically, I am a property manager right now, but I would definitely hire one because I don't have enough time nor the patience to do it all right now.
There you go. That's a good answer. I think he snuck in afterward. You're the only one, right? Everyone else got one? Oh, Brian, that's right.
Hi, my name is Sai.
I'm sorry, go ahead.
I'm an out-of-state landlord, so I would definitely hire a property manager.
Okay. You're going to like tonight's class then.
I'm Brian. I'd hire a property manager because I have better things to do with my time and make more money elsewhere instead of paying myself to be a property manager.
Awesome, thank you. All right, welcome everybody. So important note, please don't take photos of slides. We do post, provided technology cooperates, we're able to record it. We do post the videos on the website now. And then we also did the podcast. How many people have seen the podcast since we started it? All right, cool. Speaking of the podcasts, so we have 100 of the recordings of different classes up on the podcast right now. You can access it at podcast.ncraig.com, and it's got a whole bunch of stuff on there. Everything from asset protection, well, I guess asset protection is not in the podcast. Everything from property management to analyzing deals to property selection to a whole bunch of stuff on Nomad and things like that. So it's got a whole bunch of good stuff. All right, so let's get into the presentation tonight. So tonight we're going to be going over a couple things, but I want to give you some background as to kind of how we came about looking at this. So I have a bunch of clients that are buying investment properties, and one of the conversations that always comes up is, you know, hiring a property manager, is it worth it? You know, what is the cost of doing that? And it's a little bit more complicated problem than it seems at first glance. And I kind of hinted at it in the email when I said it's not just taking the amount you're paying in property management fees and multiplying by 12 to find out how much you're paying the property manager. There's some opportunity cost to that money, things you could have been doing with it. Plus, if you're using that money, your kind of proceeds from your properties in order to buy additional properties, it slows down your ability to acquire additional properties and invest. And so tonight what we're going to do is we're going to go over what are property management fees. I'm going to go over what my assumptions are exactly. And then I'm going to show you what the impact of paying property management fees are on owning a single rental property. We're going to start with the most basic thing. I'm going to show you the numbers. And I think for some of you it's going to surprise you. The next thing we're going to do is I'm going to show you the impact on buying 2 rental properties. And really the story is going to be, what do you do when you buy the first one and you hire a property manager? How long does that defer you being able to buy your second one? And then what's the overall cost of property management on the 2 properties over that period of time? And so we'll show you those 2. And then finally, for the nomads in the room, we're going to go over, or listen to the recording for that matter, we're going to go over what the impact is on property management when you're doing the entire Nomad strategy. And usually we tell people when you're doing Nomad, don't do a property manager, manage the properties yourself. But in this case, we're going to show you what happens if you do hire a property manager from the very beginning. Does that make sense? Okay, cool. So tonight is going to be more storytelling with charts than anything else. But there's a couple things we need to do first. So before we even get into this, this is like the, this can come across as me property manager bashing, honestly, right? Because I'm going to show you some numbers, and property managers are kind of taking money off the top, and for a long period of time, they actually make more money as far as positive cash flow goes on your property than you do in a lot of cases. And so we're going to walk through all those numbers, but I will tell you I am pro property management. So I actually have my property with property managers or partners, whichever way you want to look at it. And I am pro property manager, although it may not seem like that at times tonight. Okay? So I think that you should consider hiring a property manager if it's more important for you to have your time be able to do other things. And so really, when you're hiring a property manager, you're paying for a service. It's not just like you're paying them a fee and you're not getting anything for it. So if you actually did this, and you could be able to do other work beyond what you're doing with property management now, and you can earn more than what you'd be paying the property manager, you may want to hire a property manager to do that. So you could convert your time to higher and better use, or in some cases, you want it because you're already working a 40-hour, 50-hour, 60-hour a week job or more, and you want to buy free time. So after your 60-hour a week job, you actually want to pay a property manager so that you can go skiing, so that you can go and do fun things in the evening and not have to worry about additionally managing your properties. Does that make sense? I also want to point out, it's not on here, but there is some overhead to hiring a property manager. You know, there's the managing of the manager component, which is non-trivial. You definitely need to review the property management statements. You definitely need to check their work. You definitely need to keep on top of them as far as expenses on the property, making sure that they're maintaining the property to the standard that you set, that they're screening tenants to the standard you set. So there's a lot of things you need to do for managing those. And there is a class on the recording. Brian taught the managing the property manager portion of it. I taught the selecting part of it, and then Brian taught the managing the manager part, which is definitely worth listening to. So I'd go onto the podcast and do that. So to kind of get back to this though, you're paying for a service. You could be doing other work with the time you're paying a property manager for. It is not reflected in the charts. It's really hard to model you being able to go and work another job and what that's sort of worth versus doing it this way. And so really, it's not reflected in charts. If you want to think about it, you know, if you have a property and you're paying the property manager, you know, $180 a month or something like that to manage your property, and it takes them on average X number of hours, what do you think the property manager's rate is? What's your guess? What do you think they're earning? $60 an hour. You think that they're actually doing 3 hours of work on average on your property per month? You think it's lower than that? You think it's higher than that? The rate is lower. Maybe 15 an hour. I doubt it's 15 because they're usually paying somebody and need to make a profit on that, right? So if you're going and you're hiring someone at, you know, 10, 11, 12, 13, 14, $15 an hour to do the work, there's got to be enough to be in business, right, as the person. But I don't think it's much crazy higher than that. I mean, maybe 30 is my guess. But, you know, there's some properties where, you know, it's smooth sailing, there's not a lot to do, and then there's some properties where there's quite a bit of overhead. And part of the overhead is, you know, bookkeeping, accounting, doing, you know, safety checks and follow up on your properties, you know, overseeing maintenance requests and things of that nature. So there's more to it than just collecting checks and sending you checks. Okay? So if you think about what the property manager's hourly rate is, and then if you think about what your hourly rate is, if you are actually, there's an old saying in business, and that is, if you don't have an assistant and you're doing the work that an assistant would do, you are voluntarily accepting that assistant's rates for the work that you're doing. So if you're paying somebody, you know, if you pay someone $15 an hour or $10 an hour or whatever it is in order to do work for you, and you are opting not to hire someone at $10 an hour, you are actually doing $10 an hour work, and that's what you're earning, because you could hire someone else. Okay? And the same idea applies to property managers. If you actually don't hire a property manager and pay them to do the work, you are voluntarily accepting whatever that hourly rate is. Okay? All right. One of the reasons you're paying for this service, though, is converting a property to a more passive enterprise. One of the challenges I think a lot of folks have is they buy rental properties thinking that it's passive, but it really is not a passive investment. It's a very active investment. Whenever you have a new tenant turnover, you got to screen tenants. It takes a lot longer than you'd expect to do this. You have to go and manage the tenants while they're there. You got to oversee maintenance. And you can kind of make systems to make this a lot smoother, but there's still time invested and overhead. And so hiring a property manager lets you step up one level and just manage the manager instead of managing the asset itself. Does that make sense? Okay. So what do property managers charge? And this is from that presentation we had, basically selecting and managing a property manager. That's the web address if you want to go watch the video, or you can listen to it on the podcast. But here's how property managers charge. What do you think? How do they normally charge? Percentage of gross rents collected, sure. What else? Leasing fees. So whenever they actually renew a lease or they get a new lease on a property, they charge you a percentage of the rent that they're collecting in order to do that. A reference fee or finder's fee? What is that?
To fulfill a tenant, or to find a tenant, they will go out and, what's the best word for it? They'll go out and. Like a leasing fee. Yeah.
Oh, that's what we're talking about, the leasing fee.
Like essentially a leasing fee.
Yeah, so we do that.
This sounds more like if you're managing yourself, you just hire them to go find you a tenant.
Oh, like a tenant.
Like a reference or a finder's fee or a.
Yeah. Yeah, it's still like a leasing fee, sure. What else do they charge? Yes, so actually a lot of property management companies will actually charge you for the ads that they run in order to find your tenants. It's not just that they're charging you X percent, 8%, 7%, 5%, 10%, 11%, 15%, whatever they are. Sometimes they'll charge you 10% plus, a $25 per quarter or $25 per month or whatever it is to cover the marketing costs of marketing your property and all the other ones on their system. So yes, there's a marketing fee a lot of times. What else? Markup on maintenance, absolutely. So a lot of times they have either in-house maintenance or they're outsourcing it to other people and they are charging you a percentage over that to kind of oversee, meet them at the property, let them in, coordinate all that stuff. And so a lot of times maintenance is a profit center for the property manager too. Sure. What else? Inspections. So they may charge you to go out and inspect your property, twice a year or 3 times a year or whatever they're doing. Yep, they could do that too. What else? Initial photos on the property. If you're setting up a brand new property with them, they may charge you to have the professional photographer go out and take photos of the property in order to make sure that they're putting your best foot forward with the property and getting the best tenants in there. So absolutely.
Sending a check for estimated tax withholding to Sacramento every quarter.
Sending a check to on estimated tax withholding. So you're saying they charge that as a fee?
They charge a processing fee to write the check to send this.
Oh, so they charge you like an accounting, sending a check fee in order to do that. Okay, that's another good one. What else? Anything else?
Do they charge you for delinquent rent, or can they?
Yeah, so late fees, most of the time what they're doing is they're charging the tenant late fees, but almost all the property managers I know, they keep that fee. They're not actually passing it through to you. Yep. Okay, so percentage of gross rents collected, that's one of the ways they do it. Some do a flat fee per property that's under management. It may not be a percentage, it just may be, hey, listen, we charge $300 per door per month or $50 per door, or if it's vacant, sometimes they'll charge you a fee when the property's vacant just to oversee it. It might be $50 or $100 a month or something like that in order to just have the property on their books knowing that they're in charge of it. They could charge you an hourly fee. You could actually negotiate with probably a smaller property management firm to say, listen, I'm going to pay you hourly to do property management for me. You just bill me your hours at whatever rate we agree on. Or they might do something else. Do they charge a setup fee when you take on a property, and how much? Do you have a discount schedule for multiple properties from the same owner you have under management? So some property management companies may charge you, just pick an arbitrary number because it's all negotiable, but they may charge you 10%. And if you have 3 properties or more under management, it's 9%. And if you have 5 properties or more under management, maybe it's 8.5%. And then if you have more than 15 properties under management, maybe it goes down to 7% or something like that. So they may charge you some sliding scale based on the number of properties you're having managed with them. They charge the owner a fee when each time you get a new lease. Is it a flat fee or a percentage? Do you have to charge the owner a fee for each time you renew a lease? And so these are related, but sometimes they will charge you just for new ones. Sometimes they'll charge you the same fee for renewing a lease. Okay? And whether it's a percentage or a flat fee. Okay, so those are like the main ways that they make money, but there are additional ways that I think property management companies make money, or the additional costs of property management, I should say. Now we're switching over and saying, what are the costs to us? So number one, one of the biggest costs, and one of the most frustrating ones for me at least, is not maximizing rent. The amount of rent you can get in your property might be, for a lot of people, I shouldn't say this, but for some people, you can get more than what your property management company can get for you. If you're really, really good, you know your property, you're good at sales, you're good at persuasion, you may be able to get more for your property than a property manager does. So by hiring a property manager, you're getting lower rent, which is really a cost of property management in a really weird, twisted way. Oh, wait, the microphone's coming on.
The counter to that is there are so many landlords that are managing themselves that have rents that are so far beneath market rent that a property manager would actually be better for that.
That's a really good point, and I think you're right about that. There are a lot of people that are softies. Where's Denise? So anybody who wants below market, someone who you can kind of walk over your landlord, go rent Denise's property, right? Because she's like a super softie. She's going to come over and she's going to say, oh, I love you guys. Thanks for coming. You can still rent this property for $500 a month, even though it should be $18. No, I'm just saying that's the idea. There's a lot of people out there that they're super sweet and they can't say no to people. And if you're that type of person, it's good really personality trait overall, but it's not so great when you're managing properties. So
it's not even the softies though, right? It's just like, hey, I have a tenant
That's
in
true,
there,
too.
and they paid $1,200, and they've been there for 10 years, and I've raised the rent to $1,300, when really rent is $1,950.
That's right. And there's something to be said about you have a tenant in the property, they've been there for 4 or 5 or 10 years, and you don't have to replace carpet, you don't have to update the kitchen, you don't have to update the bathroom. And yeah, giving them below market rent may still be better for you, but not to that extreme. Or 21 years, yes, for a specific property Brian is mentioning. Okay, so not maximizing rent is an additional cost of hiring a property manager. The other one is maintenance. I think Christoph was the one that said this, right? You said basically that they charge you a fee. So remember, for asset protection reasons, we typically do not recommend that you do any repairs on your property, no matter how small. And if you're doing your property in some type of IRA or 401k, you're not supposed to be doing maintenance on your property to begin with anyway. But for asset protection reasons, we don't do it. But if you're going to have a property manager do maintenance on your property, a lot of times they will either have their in-house property management company do the work for you, and that's a profit center for them, and or they're going to have outside people, contractors that they hire, and they're going to charge you an oversight, some type of like premium above what they're actually paying them in order to oversee the management on that, okay? The other one is vacancy. So if your property manager doesn't know that the best practice is to start marketing your property 90 days ahead of time in order to minimize vacancy on your property, then if they're waiting for the person to move out to then go in there and evaluate what needs to be fixed up and getting the next person in there, that's a huge issue. And you're actually ended up paying for that as the owner of the property. Because you guys all know to do that. You guys all know start 90 days, at least 60 days in advance to get your tenants in there and do this. And if your property manager is not doing that, that's a real problem. Late fees. So I know certain investors here in town that they've told me in the past the amount of money they collect on late fees pays for like all of their car payments. So they've got enough properties where the late fees that they collect pay for their car payments on their properties. Well, I mean, if you have enough properties and you have a certain percentage of them that are constantly paying late, I mean, you add them all up and it kind of just gets to be a point where it's significant, right? So if you get to that point, it's pretty significant. So your property manager is actually charging and collecting those late fees. They're actually making that money, not you. Not that I think that should be considered a profit center, but it is something that you actually end up eating on that. And then junk fees. So there's all sorts of fees. Some property managers, not all of them do this, but some will charge you like a fee for your share of the paper that you use in their office, or the internet marketing ads, or what did you say, Christoph? Oh, sorry.
Then some of them charge you $1 to send out a piece of mail.
Yeah, like they'll charge you a small premium or postage or something like that. So there's all these like what I consider to be little kind of trivial junk fees that add up, and it kind of does that. I think other property managers roll it in there. Some of them do that, but just kind of be aware that that is another cost sometimes for doing property management. All right, so for tonight's class, and for what I modeled in the Nomad Calculator 3, I've assumed that the fees we're talking about are 10% of gross rent collected. I think that is a pretty middle-of-the-road cost for property management. You probably can find some that are willing to do a little bit less. You probably find some that are charging a little bit more. But basically, it's going to be 10% of the gross rent collected, plus every time they either lease the property or they release the property, they're going to charge you a 20% of the rents collected leasing fee. And so that really works out to be, in most cases, once per year that they're charging that. So if you add up this and this, it turns out the amount you're really paying is 11.667. Anybody want to check my math? Because otherwise the rest of the presentation is garbage. Because it's all based on that. It's wrong? Okay. I've also assumed that we are not increasing maintenance, so the maintenance is not going up on the property. We're assuming that it's just the same as before, and that they're not increasing vacancy. We've never modeled late fees when we couldn't do our analysis anyway, so that's not being modeled. That remains unchanged. And rent is based off the actual rent received with the property manager and keeping pace with inflation. So we've assumed inflation is about 3% a year. Rents over the last 5 years or so has probably gone up more than 3% a year, but over a very long period of time, rent is going up about 3% a year. We're not doing any junk fees, and we did not give a discount when you acquire a certain number of additional properties. It's not like when you do Nomad and you have 10 properties under management, you are now down to 7. We're assuming it's 10% for that whole time.
Predicated on single family.
Where's Mike? No worries. Otherwise, I get yelled at because people can't hear the questions.
Predicated on single family.
It doesn't really matter, although we are talking about single family tonight. I'm going to go over a very specific property, but otherwise, really the math is the same, or the expenses on it. Yeah, sure. Awesome. Tam, you want to hold the mic and do mic stuff? Thank you. Or Brian can have it because he's probably going to comment a lot. This is going to be the same property for the entire presentation. I'm not going to mix and say you're buying one property that has amazing cash flow and then another property that has horrible. I'm not saying that the 10 properties you're doing in Nomad, one's amazing, another one's bad, next one's amazing. It's basically going to be the same exact property for all of the examples tonight so that I can kind of show you a apples to apples comparison as best we can. So it is based on a brand new construction property that you purchase in Severance for $325. With really recent price increases, that price is probably a little bit low now. I think they've gone up 5 or 10K since then. And so really it's probably 5 or 10K more. And that includes $5,000 in seller concessions, and that covers your closing costs. Interest rate for non-owner occupant, who are my lenders? Is 5.375 for a non-owner occupant about what today's rate is? It is. Okay. And then what about an owner occupant? Is 5% about pretty good? Might be a little high? Okay, so basically we're in that ballpark, but that's what I'm using for my assumptions tonight. So any investor property you're buying, I'm using 5.375, and for owner occupant, I'm using 5%. The rent on this property, just had it rented by a property manager, they got $18.45. I bought one of these in February. My numbers are a little bit different because I bought it like last year, but it just got built in February. Rent is $18.45 per month. The inflation we're using for all of them is 3%, and that includes rent, price, taxes, insurance, the amount you save each month if we're going to do that, which I'll show you later. But all of those are basically inflation, 3%. I'm assuming this particular property is in a metro taxing district. Taxes on this property are 1% of the property value per year for taxes. And I'm assuming 0.4% for insurance. Is Brian in the room? Any other insurance agents in the room? 4.4% of the property value as the insurance amount. Does that seem reasonable? It's going to be about $1,200 or so a year. Yeah, so really, this is the challenge every time we do estimates for insurance, is if you decide to have a $5,000 deductible, your insurance rate is going to be very different than if you choose a $1,000 deductible. And so it's really, really hard. And by the way, if you have good credit, very different rate than if you have bad credit. So the insurance rate you get is all over the place. And so I think that is $1,200 a year on a rental property in the ballpark. Okay. And then we're using 10%. Set aside 10% of rents for maintenance. And remember, this is brand new construction, so in the first year or two, maintenance should be a lot less than 10%. But over time, when you're holding these properties long term, 10% might actually be a little tiny bit high. I'm sorry, a little tiny bit low. Okay. Any questions on the assumptions for the property? Cool. So sometimes, and I'll tell you when I'm going to do this, sometimes I'm actually going to assume you're going to get an interest rate on money you have in the account. And actually, this is not the slide for that, so I'll talk about that later. So tonight, basically, we're starting off for the 20% down payment scenarios where you're going to buy a rental property. I've assumed that you're starting with $83,000 in cash. That is enough money for you to do your down payment, which is going to be 20% down of the $325,000 property. Plus, you're going to have enough to hold out with negative cash flow, including your property management fee, so that the balance doesn't really go negative. Okay? So in this case, the $83,000 gives you 20% down, covers your negative cash flow, covers your property management expenses, and in the worst scenario, your bank account balance goes negative 127. Okay, I wanted to do it. I didn't want to do 83,127, so I just said 83,000. Make sense? Okay. So for Nomad starting with 0 down, for when we talk about Nomad in the third step, you're basically, the assumptions are going to be your starting account balance of 5K. So you're going to be able to acquire 11 rental properties starting with $5,000 in your bank. The other one, we're starting off with 83,000 to do 20% down. Everyone follow along? Any questions? Okay. So let's talk about one rental property. So you're going to go in, you're going to buy that $325,000 rental property. You're going to put 20% down, whatever that worked out to be, $65,000 or so. And this is what your cash flow looks like, your true cash flow, trademark, when you actually go buy the property. True cash flow, for those that don't know, it's a trademark. It's a term I invented. It's trademarked. Brian's rolling his eyes. True cash flow includes your cash flow from depreciation, and CapEx. In this case, where CapEx is 0. So really, you're going to talk about your true cash flow, which includes depreciation, and it works out to be, in the first month, you're negative $80 or so, after taking into account tax benefits on buying this property new. It stays about a negative, almost negative 100 until you actually raise the rent in year 2. Then it becomes negative 50-ish. Then it goes up. It basically comes down to negative 25-ish in year 3. And then eventually, about 36 months in or so, it becomes slightly positive. So with this property in our marketplace, which is, it's really, really hard, especially as interest rates have gone up and the rents have not gone up quite as fast, it's really hard to find positive cash flowing properties in our marketplace that you can buy brand new, okay? And so right now, it's negative cash flow. This is not with property management. This is you just buying it. Basically, you have slightly negative cash flow for the first 3 years, then it becomes slightly positive and increases over time. Does everyone follow along with this? Brian's giving me a weird look. Where's your microphone? So what happens is, your taxes actually change in January every year. And so you actually have 2 months of a dip, because I assumed we were doing this in March. So there's this really weird thing that happens. But see, this is what happens when you do monthly numbers. You actually see when things happen and you're modeling it right. Yep, that's a good question. So Brian asked, if he wasn't on mic, what happens in month 11 and 12? All right, any questions on this? Cool. So if you decide to pay property management, that's the blue line. So if you're paying property management, you're actually negative $300 per month. When you're doing just your property, it's negative $100 or so. And you can see with property management, it follows the same curve, but it's still negative even 5 years out from paying the property management. Whereas your other one got positive after 3 years or so. Okay? So you can see that with property management, it's a couple $100 more negative per month. All right, so here's what it looks like over the entire duration. So you start off negative the property management one. When you're paying property management on one property, it's the blue line at the bottom. What happens here in year 27 or so? Why is there a little dip in this chart here? No more depreciation. So we stop getting cash flow from depreciation in year 27 and a half. So you have a little dip here for the cash flow from depreciation. And then what happens here in year 30? The property is paid off and you get all the cash flow. Okay? So the blue line is your one if you're paying property management. The red line is the one if you actually do not pay property management. What's interesting is you don't go positive on your cash flow until month, whatever that is, 120 or so if you're paying property management. So it takes you 10 years to become positive with cash flow paying a property manager. Make sense? Oh, this is just the beginning. Yeah, in this example, which I think is a pretty typical property in our marketplace right now. Yes. Snapshot with interest rates where they are, property values where they are, and rents are where they are. Okay.
For a single family home.
Single family home, absolutely. Okay. All right, so in month 109, true cash flow with property management then becomes positive. So this is basically month 0 through 120. Right here in month 109 is when you actually go positive with your rental property in our current market when you're paying property management. It went positive way back here in month 36 or so if you were not paying property management. So you get basically a 7-year head start on positive cash flow if you do no property management. Okay? So here's how much you're paying your property management fees. This is one where you're not paying any property management fees. It's the red line that's hugging the bottom. But if you're actually paying property management, it starts off at just over $200 a month. That's 11.67% of $1,850 a month in rent. And it goes up each year as your rents go up until you're finally, by the time you get to year 40, which is where this is on here, you're paying just over $600 a month in property management fees. Okay? Total cumulative property management fees. This shows you the sum. If you add up all the property management fees you paid over this time period with an inflating, rent, rent costs, your property management costs, all that stuff's going up. So basically, it goes whoop like this and ends up being about $180,000 or so. So over the course of a 40-year period, in exchange for not having to manage the property yourself, in exchange for not having to find your tenants and screen them and looking at your property and doing all that stuff, you end up paying about $180,000 in property management fees on one property. Okay? So this is an interesting chart. It's a little bit busy, so I want to kind of rebuild it. So you remember before we talked about your cash flow. This is your cash flow when you're paying property management. You kind of see it go there. And this is basically 20 years in. This line is your cash flow if you're not paying property management, the red line. And the green line is sort of like the cash flow your property manager is collecting on your property. It's the property management fee that they are getting. So what's interesting to me is your property manager, who's sort of like an unofficial partner in your property. They're kind of taking a proceeds from your property by managing it for you. They're getting about $200 and something per month, whereas you're negative for the first year or two. Okay? It takes until about year 10 before the amount of money you're getting in cash flow exceeds the amount of money your property manager is getting in cash flow if you are not paying a property manager. Okay? If you're still paying the property manager, it takes till year, whatever this is, year 11, before you are actually making more money in monthly cash flow than the property manager is making on the property. Is that interesting? Brian's going to do some math. Okay? But that's basically what it looks like. Is that interesting to anybody? Anyone other than me care? Okay.
It's actually like year 17. Yeah.
Oh, it's month 200 and something.
Like year 17.
Year 17. Yes, Scott. Oh, wait, get a mic. Where's the mic?
So just a question of clarity, please.
Yes.
So on the true cash flow, when you're looking at these things, so it's not really actual cash that we're looking at, like an actual cash basis. So when you're talking about these losses, that's after factoring. Did I hear you say?
It includes cash flow from depreciation.
Depreciation, huh?
Yep. So it takes into account the amount of money you're getting back on your tax return from owning that rental property.
So on a cash basis, you're actually losing more on a month.
That's correct.
On a
That is
cash
absolutely
basis.
correct. Yep.
Until.
Yep. Good question. All right. So this then shows you the cumulative amount you paid in both property management. This shows you the cumulative amount of true cash flow or property management. So the green line is your property management. This is how much you've paid cumulatively for property management over the time. The blue line is how much you've collected in cash flow with property management over time. And so it takes you to month almost 360, it looks like, before you've actually collected more cumulative cash flow, whether that's negative or positive, than you've actually paid out in property management fees. So almost 30 years in before you've actually collected more cash flow than you paid to the property manager on your rental property. That's pretty crazy. And if you don't decide to actually pay a property manager, you exceed the amount of money they would have made in month, whatever that was you told me, 210 or 17 years. Okay? All right. So remember, we started with $83,000 in our bank account. Once we put in our down payment and closing costs, we're left with about $18,000 in your bank. So that's what we're showing you starting here. Then this is showing you what your account balance looks like over time as you're paying out property management fees or negative cash flow. And so right here is the one with property management. You can see it goes much further negative because you're paying out some negative cash flow and your property management fee. And it sort of bottoms out here, I don't know, whatever month that is. Year 9 or something, month 110. The one where you're not paying property management bottoms out much earlier where it starts to become slightly positive. Okay? So this kind of shows you just your account balance. So this is zoomed out. This was basically just to the first 10 years. This is the same chart zoomed out showing you that over time, the account balance, how much you have in your account if you don't hire a property manager, is more than if you actually hire a property manager and you're paying property management fees. This makes sense, right? You're paying part of it out as property manager, so it doesn't go in your bank account, it doesn't accumulate over time. So this is the difference between the two. This is the amount. So at the end of 40 years, and realize this is a long time out, right? So these numbers seem much larger, but it really is 40 years in the future. 40 years in the future, if you actually don't hire a property manager, you actually have $654,000 and change in your bank account. If you do hire a property manager, you have $466,000 in your bank account at the end of the 40-year period. Does that make sense? Okay. If you adjust for inflation, if you say, listen, $1 today is not worth $1 40 years from now, what is it worth in the future? 40 years in the future, that amount, 654, is really only worth 201 in today's dollars. So it's like having $201,000 in your account today.
So you're poor either way.
You're poor either way. And this one in the future, it's $143,000. So the difference between the two is, what is that, $57,000 if you adjust for inflation with one rental property. Is that like, is it worth it to have someone manage your property for 40 years for $57,000? And I think for a lot of folks it is. Brian's smiling and shaking his head. Okay. So the difference over 40 years, it's almost $200,000 in future inflated dollars. It's about $57,995 in inflation adjusted dollars. And since it's the exact same property, we're just kind of doing two different scenarios, everything else is identical. The only difference is really your account balance. You have the same appreciation, the property's worth the same, you have the same exact debt pay down, so all those things are the same. Now, Brian probably has a question, but there's an interesting thing though. So same debt pay down, same appreciation, same depreciation. There is one thing that could be slightly different, and that is because you are paying out of pocket for property management, you probably have an additional tax benefit as an expense on the property. It's relatively small. I mean, you're talking about a $2,000 a year expense, so it's not going to make a huge difference, but it does make a slight difference, and is not something I modeled. 80 grand over 40 years, and actual gross expenses on the property, though. Yeah. Okay? It does not take into account being able to reinvest that money over time. So the numbers we've been talking about so far have been, listen, you got a certain amount of money, but you just let it sit in a savings account earning 0%. You didn't invest it in something else in the future. You didn't do anything with it. And if you actually take into account what I consider to be the opportunity cost of having that money, it actually gets worse. And so I'm going to show you what happens if you could take the money that you didn't pay to property management fees and you could invest any idle cash you have and get a miraculous, amazing 8% return in the stock market. Okay? Which I think is optimistic, by the way. All right? So, total account balances. If we actually invest, if we do property management, but we're able to invest anything we have in the account in an 8% stock market account, we end up with over $1 million in our account in year 40. If we do it and we don't hire a property management company, but we still get that 8% return on our same money we had sitting in the account, we end up with just over $2 million in our account. So really, if you compare all four of these, this blue line is you get 0% return on your money, but you actually pay a property manager. The red line is you get 0% on your money, but you did not hire a property manager. The green line is you got 8% on your money and you hired a property manager. And the yellow line is you got 8% return on your money and you did not hire a property manager. So the best thing you could do is not hire a property manager and get 8% return on your money, which makes sense to us, right? So that one works out to be just over $2 million, and you can see the other relative positions. In case you couldn't tell, I kind of zoomed into year 40. Basically, you have $2 million there, just over $1 million here, just over whatever that is, 600, 700,000, and just under 500,000 for the four different scenarios we just covered. You want to say something?
Yeah, I mean, to be fair, that's not the best. That's the best out of those four options.
Agreed. Yeah,
right?
Totally. That's
like,
one property.
Right, but the best option is have a property manager and go make 5x that doing something else.
Totally agree, because you could do work with that time and then earn more money. You could go buy another property, you could go hustle and build another down payment, you could structure a syndicate, bring other investors that have money. You could do totally different things with that, and yes, you absolutely could do better.
And make more than 8%, which you're probably not going to make in the stock market, which you've already discussed before.
Totally
so
agree. I totally agree with you. And so this is not intended to be a property management bashing class. It's intended to open your eyes as to what the real expense is, and then realize that in order for you to make this a worthwhile investment to hire a property manager, you need to do something else with your time or really enjoy your time because it has a cost. Okay?
Go
ahead, use the mic.
It also might indicate that if you do hire a property manager, you have some rights to have expectations because you're not getting it for free. There is a cost, and they make it sound like, oh, we're just getting this much, but you're paying a valuable price. So you should have expectations.
I think that's fair. Yeah.
One of the other interesting things, it was way back on the first slide, but
you want me to go back?
No, I think this is true, but I don't have any thoughts about what to do about it because the longer you own this property, in my opinion, like if you managed it the first 20 years and then you're like, yeah, I'm done doing this, right? And you hire a property manager, it doesn't solve this problem, but it's not a linear curve, right? You're actually paying more in the later years because you're compounding the rent increase. So your average when you pay later is actually more. And so I don't know if there's anything we can do about that because rents are going to typically go up at 3% a year, but you're paying less now and more later. Right?
You're not paying, you are paying more later, but you are paying a greater percentage of your cash flow earlier on.
Agreed.
Yeah.
Agreed. But like dollar wise, it's the cost is going up because you're compounding 3%, 3%,
Yes.
3%, 3%. So the property management fee is as you continue to compound your
Yes.
compound your rent, you're
It goes
paying
up at
more and more and
3%
more.
too.
Right, but
Yes.
it's compounded, right?
It is a 3%
'Cause
compounding
when you
rate.
look at the curve, it's not flat, it's this. right?
Totally
You're
is.
going to continue to
Yeah, because you're getting 3% on whatever it was last year, and so you're compounding it on top of each other. Yeah.
But also in those later years, there's a lot more to do on the property. So if you're all worried about time and effort,
Yeah.
the early years, a brand new property, you're collecting rent, you're getting people in who want new properties. It's a lot easier. I'm in
Yeah.
a property now that I'm now at that 18-year point and things are happening.
Yeah.
Now I have to make a choice. Do I want to spend the time on those things or do I want to hire somebody?
Totally. Totally. So in the email earlier today, I basically said to you, this is $1 million class to you. So this is one property. The property management cost, the difference between hiring a property manager and that is basically that amount of money. Okay? So it's $954,132, which squint really hard looks an awful lot like about $1 million. Over 40 years. Pause for dramatic effect. Okay? So if you adjust for inflation, because money 40 years in the future is not like money today, it really works out to be $619,000 in the future compared to whatever this number is, 300 and change, which is a $293,217 difference between hiring a property manager and not, if you're able to compound and take the opportunity cost, an 8% opportunity cost on that money over that same period of time. Okay? All right. So this shows you your net worth, no property management, but various stock market rates of return. So if you were not going to hire a property manager and you were able to get 0% return on your money, any idle cash, it works out to be your net worth is 1 point, whatever that is, 8. The next one's a little bit higher, like 1.9. The next one's a little bit over 2 million. This is actually 6% is 2.5 million, and then 8%, which is what we've been talking about as the high end, is just over $3 million net worth, and that includes the value of the property and the value of your bank account from collecting all the fees you've collected over that time period. Plus 8% on any idle cash you have in your account at that time. Yep. Okay. So you can see the relative differences. If you actually hire a property manager, this is the various returns. If you do the 0%, it's 1.5, just over 1.5, 1.7, 1.8, and then 2.1 at 8%. Okay? All right. So what is the impact? So we kind of talked about doing this with one rental property, but what's really the impact? What's your ability to buy the next property when you have a property manager who's eating into the cash flow you're using on the property? It affects more than just how much you spend. It affects timing. It affects how much you have that you can use for a down payment for the next property. So how much cash flow you have impacts how quickly you can come up with your next down payment, and this impacts how quickly you can buy your next property, and how fast you can buy that next property affects how quickly you start paying that down, how quickly you are on the ownership side of the asset where the property value is going up, and how quickly you can get to positive cash flow, because the longer you hold your property, the more cash flow you have because you have fixed mortgage expenses and rents and stuff like that are going up. Okay? So it has an impact on all this stuff. All right, so when you're buying your second property, what I've assumed is I've now put into the equation that you are saving from your job $160 per month and adding that to an account to save up for your down payment. Any positive cash flow you might have also gets added to that account so that eventually over time you have enough money in your account to put 20% down and buy your second rental property. We're assuming you start with $83,000 in the account at the very beginning and that you are using that to buy your first property and then you're saving for the next one. I'm also assuming that you're increasing this $160 per month that you're saving by 3% a year. So as you get raises with inflation, you are starting to save more and more each month. So by the time you get to month 13, a year in, you're now saving $164.80 instead of $160. Okay? So for now, we're assuming you're not getting any return on cash sitting in the bank. So we're starting off again with 0% return on investment. So here's what happens. If you actually don't hire a property manager and you're saving $160, you own one property at the very beginning in month 1, and then you can buy your very next property basically 200 months in, and it actually jumps up for your second property. If you hire a property manager, and your property manager is kind of taken off the top for the services that they're providing, basically it delays your ability to buy by about 100 months. So 207 versus 305. you can basically buy a property 98 months earlier by not hiring a property manager. It's 1. It's not $1. It's basically the number of properties. We're going to go over stuff later on price and stuff.
Yeah, I get that it's one house. I'm just asking, like, what is the actual shortage on when you can buy the house with the red line?
Yep.
What is the shortage in dollars that you would need to make up to actually force the blue line to be where the red line
Well,
is?
I guess we could look at what the property manager
Like,
cost
how much
is.
do you need to earn extra across 210 months in order to make it up?
So we could figure out what the property management cost was over 207 months to figure out what that is. So it's about whatever that was, $200 and small change per month. And so you figure $2,400 a year times, what is that? 17 years is what you told me before? Something like that.
And what's the average? What does it start at per month?
It's just like 200 and change, 220 maybe? Yeah, something like that.
That's only for fees, like the basic fees, not for increases over capital maintenance and all that.
Nope, we're assuming there's a maintenance set aside on the property, so we are including that, but we're not including that it's more expensive with a property manager. So they're the same for everything.
So not the increase that they put on top of maintenance.
No, we're just assuming that it all gets covered in that. Because there are times when we as consumers might actually pay over market price for something because they have a guy that can do it, right? They may have a really good rate on hot water heaters where you might go to Home Depot and pay for it, and they are charging you something, but it's still less expensive or equal to what you would pay if you went to the store. So it's possible that that could happen.
And I assume when you're looking at down payment here, you took appreciation into account?
I do.
Okay.
I do take appreciation into account, yeah. That's a good question. I do. All right, so that's basically what happens there. So let's take a look at your true cash flow in the two different scenarios. So if you're hiring a property manager, you start off with negative cash flow, just like we did before. You got one property at this point. You got negative cash flow. At this point, about 100 months in or so, you eventually become slightly positive with your cash flow, and you go here, and eventually, if you hired your property manager, you eventually get to this month 300 and something, and you end up buying your property. This first month is when you get a boost from cash flow because you don't have a mortgage payment on your first month when you own a property. You basically get to skip a month, if you remember that. And then it goes down, and this is what the new cash flow is after your cash flow kind of gets into effect. And so it's lower than it was before because the property that you just bought has negative cash flow too. Then it slowly increases over time. Eventually, what happens here? What happens in month 360? The first property you own gets paid off. So your cash flow bumps up, and then it just kind of snakes along here and continues to increase over time. So that's the time frame if you're paying a property manager on the property. The red line is actually if you do not pay a property manager, and you kind of go along and you end up buying the property earlier. This is where you bought it before, month 300. Now here's where you're buying it next time, month 200 and something. And so same type of idea. Your negative cash flow here, it continues to go up. You pay off your first house here, and then it continues to go up from there. So that's what your cash flow position looks like between the two scenarios. One's much sooner because you're not paying property management. Does that make sense, everybody? Okay.
So rough calculation, it's about, I think, just by trying to rough some numbers out, it's like $125 a month that you would need to earn for those first 220 months in order to have enough in the account extra. So it's about 26, 27, somewhere in the 30K range.
So if you like doing a certain amount of work, a different type of work, and you can earn money there, that might be better for you than trying to become an expert at managing properties and doing it that way. You want to pass the mic?
So if I understand correctly, I mean, it all comes down to opportunity cost for your time and your money. And it may change at different points.
I think that's fair too. I think it is an opportunity cost type calculation, which is really hard to do. But now at least you know what number you need to hit to do that. Yeah. And there's an additional opportunity cost like mathematical calculation of you have money sitting in your account that you no longer had to spend, and you can get a return or invest that or do something else with it, which you'll see compounded when we do the Nomad one. Yeah. Okay. So then now we just did cash flow. Now we're going to do equity. So because you're able to buy the property earlier, if you don't do the property management, you end up getting a boost. This is your down payment. So you actually get your down payment. Now you've converted down the amount of money in your account to equity. So you buy the property earlier, and then this now grows 2 properties equity over time. Whereas where you wait, if you paid property management, your boost comes here much later, and it grows. And so you have this difference in your equities over time. Does that make sense? You buy them faster because you're not paying property manager. You get more equity in your properties. Okay. So here are your total property management fees. Basically shows you how much you're paying per month on this. And then it goes up here because now you've got 2 properties in this particular one. This line is because you're not doing any property management in the first example. It's 0 the whole way. Okay? But this one's where you bought your second property. All right, so this is that chart from before where we talked about how much the property management fees were and then how much you're collecting in cash flow. You could see basically when you are paying a property manager, it takes about almost 200 months before you get to the point where you're making as much in cash flow as your property manager is making on the properties. And if you actually don't pay property management, it would have been around month 100 or so where you would have been making as much as the property manager is making. Okay? I'll also point out that when you buy your second property, it drops below the line. So you actually reverse it again. You end up earning less than your property manager does for a period of time too, until you pay off the property and then you start getting better cash flow. Okay? This is cumulative, just shows you the total amount of property management fees you pay. That's the green line. The blue line is how much cumulative cash flow you've gotten over the whole duration. Basically, it takes you to almost month 400 before you end up making more money than your property manager did on that property in cash flow. Now realize, cash flow is just one part of the investment. And this is, by the way, if you think about the 4 areas of return, appreciation, depreciation, cash flow, and debt pay down, really this cash flow number includes 2 of them. It includes both cash flow and the tax benefits, because this does include cash flow from depreciation. So really, you're kind of like showing in this chart just the comparison of cash flow and depreciation. You still get appreciation, the tendency for property values to go up, which is way higher than what your property manager is getting paid, and debt pay down, which is also higher. Does that make sense to everybody? Okay. So here it is at the end, month 480. This is how much cash flow you had if you didn't hire a property manager, $836,000 total over that whole period. And then the blue line is how much you made in cash flow, and the green is how much you paid in property management. And these are the ones where you're managing. If you add these together, it should equal this. Okay? Net worth. So if you actually hire the property manager, your net worth is right here, 2.2 something or something like that. And if you actually don't hire it, it's right here, which is almost 3 million, 2.8 or something. So 2.167 versus 2.8. That's a difference of $638,255 for hiring a property manager versus not hiring a property manager with 2 properties. Okay?
I'm a bit surprised about the previous one here, and the equity going that high on just 2 houses with a 3% increase per year.
It's 40 years.
I mean, 40 years, every 10, I mean.
Go in your calculator, type in 1.03 raised to the 40th power, and then multiply that by 325,000, and then multiply it by 2, because there's 2 properties. Yeah, but rule of 72 is it's a hard one to do for 3%.
I mean, is the $3 million house today was only worth $300,000 40 years ago?
So the actual the inflation rule is at about 3 times in 40 years. So it basically is 3 times as much. So a property 40 years ago would have been $100,000. That's what that number says at 3%.
Okay.
Yep. Okay. So that's your net worth. We talked about that. This is in inflation-adjusted dollars. So it was $666,000 if you hire a property manager, or $862,000 if you do not, which is a $196,000 difference in your net worth by doing 2 properties. All right. So again, opportunity risk. If you took the money you had and you invested it in the stock market, you got an 8% return. Again, this adds extra risk. What if you were trying to buy the second property and you had a market correction where the market went down 50%? Now that $70,000 you needed in your account in order to buy it is only worth $35,000. You're kind of SOL, right? So you add risk, and you could do better or worse than 8%. I think 8% is optimistic. And it speeds up your buying ability. So if you think about it, if you're getting a return on your money, you can buy the property earlier. So this is the same chart we had before. The blue one is 0% return, and you hired a property manager. That's the longest time it takes you to buy your next property. It's basically that month 300 or so. If you actually don't hire a property manager and you got 0% return, that's the red line. So it's a little bit earlier, about 200 and something months. 207 months maybe, is your time to do that one. If you actually got your 8% though, that becomes this green one, and you're able to buy it earlier, 203 months. Okay? And then if you actually are able to get without your property manager and you're able to get 8%, you're able to buy it much sooner, which is 131 months or 10 years in. So you're able to buy your properties a lot faster when you do that. Okay? Here's your total true cash flow, and I'm going to kind of build it up because I know they were busy. So basically, you got your rental property, you're getting 0% return. This is your cash flow on the property when you start in 0. Over time, it becomes positive, and this is you paying property management. And then you buy your next property, still goes negative, and then you pay off another property, and it goes positive. So that's the one, 0% hiring a property manager. The next one is 0%, you do not hire a property manager. That's the red one gets added. You're able to buy it earlier, and then you're paying off the property, and your cash flow continues to improve. Then the next one is 8%. So you're buying your property, you have a property manager, you're able to buy it sooner than you were here before, where you were not doing a property manager, and then you actually go here and you pay off the property and it continues to increase. And then finally, this is the one without a property manager, and you're getting the 8% return. You could buy it way earlier, increases till you pay off the property, and goes from there. Okay? So here's the difference. These are the two with property manager. These are the two where you're not doing property manager and you're getting 8% return on these two. Does that make sense? So it's good to get 8% return if you can, and it's good to not hire a property manager if you don't have something better to do with your time. Equity, same type of idea. Shows your equity positions. Because you're buying it much sooner, your equity goes up earlier. These are the two that were in the middle, and this is the one where you were not getting 8% and you were hiring a property manager. So your equity goes there. These two are pretty close. The red one and the green one, which is 0% or 8%, one of them with hiring a property manager and one of them without. Okay. So here's your total equity position in month 480, basically year 40, 2 million, 1.9 million, 1.9 million, 1.7. Net worth. Your net worth is best with the one where you're getting 8% and not hiring a property manager. It works out to be about 4.5 million. Here it's 3 million and change, just under 3 million, and then just over 2 million for total net worth. That's basically the value of your properties minus if you own on a loan, and then the amount you have in your bank account at that point. If you were earning 8%, you got that. If you were not, it didn't. Here's the difference. 4.6 to 3.1, basically just under 3 and just over 2. Make sense? Okay. Net worth, this is adjusted for inflation. 1.4, just under a million, just under 860,000, or just over 860, and then whatever that is, under 750. So all we did is took these numbers and adjusted for inflation. All right, so we've kind of gone over one property. We've gone over two properties. Now what happens if you're really relying on the money in order to go buy your next property doing Nomad, where you only need a small down payment to continue with this? Because with Nomad, we're using 0% down for the first property purchase, and then we're saving our money. We only need 3% down for the next purchase. And then we only need 3% down for the next one. Then we only need 5%, 5%, 5%, 5%, 5% until we get to property 11, and then we stop. So what impact does paying property management versus not paying property management have on a much more kind of like cascading model, where you're kind of leveraging money in order to do that? So historically with Nomad, we've told you, do not hire a property manager, manage your properties yourself. It's a way for you to actually be able to do the whole model with less money and faster. But what if you did hire a property manager to do that all from the very beginning? What impact does that have on cash flow, your account balance, the speed of acquisition, and your net worth? So let's take a look. The first purchase, we're assuming you do it with nothing down. Before tonight, we primarily told you probably doing your first purchase with 1% down. It was a special loan program that allowed you to buy properties with 1% down. It was basically a 3% down program with a 2% gift from the lender. That is going away as of May 31st. So we're not going to teach it anymore because it's twilighting. So after this date is no longer available, so now we're telling you to do 0% down, USDA, VA, or there's another bank in town, I think Compass, that allows you to do a 0% down loan program, owner-occupant. Then after that, you're doing 3% down for the second and third. And then number 4 through 11, you're doing 5% down. And your final owner-occupant, the number 11 one, you're going to do 5% down as well. The interest rate, again, for the non-owner-occupant was 5.375, which we thought was actually pretty close to being right on for now. The interest rate for owner occupant was 5, which we thought was a little high. Is that right, Scott? Okay. So probably better to just pay PMI, and then when your property value goes up, your actual thing goes down. But realize if you're doing this, you're rolling in PMI into the loan, that you're going to have a slightly higher rate for the whole duration. And I did not model that into the Nomad calculator yet, but that is something you will want to look at and compare if you're actually going to get a loan on a property and do Nomad. Otherwise, exact same property we've been talking about. $325,000, getting $5K in seller concessions, same rents, same purchase price, same maintenance. Everything else is identical except for loan. So for Nomad, you're starting with $5K in the account. Before, what did we start with? $83,000. So right now we're going to actually start with $5K. So you're able to do that. We'll start with a 0% return in your bank account, and then I'll show you the 8%. So we're modeling this on a household income of $5,000. That is you and your spouse grossing $15 an hour each. Okay? Your income tax rate at about $60,000 a year, 17.9%. We are taking off taxes. $1859.37 per month is expenses other than housing. And your housing expense is the actual cost of borrowing on the house with taxes and insurance calculated correctly based on the purchase price. And actually the price going up over time. So you're going to buy your next Nomad account when the account balance reaches enough to do so. So basically I say when you have enough to have a 3% down payment or a 5% down payment plus some small buffer, I want to make sure that you have enough to deal with negative cash flow and stuff. So we're going to say you have to have the down payment plus $6,000, whatever that is, adjusted for inflation over time. So 10 years from now, it's actually higher than $6,000. You need that amount plus your down payment in order to do it. It's intended to give you some emergency funds and from preventing you from going negative with negative cash flow. Does that make sense to everybody? Okay. So here's the number of houses owned if you do not have a property manager. So before, if you were basically on this plan, you're saving $160 a month towards your Nomad plan. You started with $5K in your account. You buy a nothing down home right here. It takes you about 4 years or so to have enough down payment in your account to buy your next property where you have $6,000 buffer and 3%. Then you buy another property. Takes you another whatever number of years this is in order to get to the point just shy of 100 months to buy your next 3% down property. Then you kind of wait a little while and you have enough here, about a month, 150, to buy your next 5% down property. Wait some time, buy another 5% down property. Wait some time, 5% property. Wait some time, 5, 5, 5, 5, 5. This is the house you live in permanently, house number 11. Now you've got 10 rental properties and you're living in house 11. You bought one of them with nothing down, 2 of them with 3% down, and 8 of them with 5% down. Make sense? Okay, so that's if you don't do it, if you don't hire a property manager. What do you think it looks like if you have a property manager? This is it. So it takes you longer, it takes you the same amount of time to buy the first property, but then the next property takes you longer, Why does it take any difference to get to number 2? Because you're living in it. You're not paying property management on the one you're living in. So basically this one's a freebie. Then all of a sudden you're paying property manager, it gets delayed until finally takes you to month 400 in order to get to your 11th property, where before you were able to do it in month 280 or something like that. So it's a lot faster. Now this has cascading, compounding effects on things, because it's not just the number of properties you own and when, it affects cash flow, it affects your equity, it affects a whole bunch of other stuff. So here's your here's your property management fees. So before, when you don't have any property manager, when you're not hiring one, you have nothing. But here's where you start paying property management fees, increases, until eventually your property manager is collecting about, I don't know, $6,000 a month in fees from you. Okay? How much your cash flow? So this is one, if you don't pay a property manager, your cash flow goes a little bit negative when you buy your first rental property. You buy another one, it goes a little negative more, a little negative, until eventually you get to the point where it's pretty positive and you're making just over $20,000 a month in positive cash flow on your rental properties. On 11 properties, one of them you're living in. Here's the cash flow when you do the property manager. Much more negative, and it doesn't really get positive until, I guess, right here, month 300, where you're doing that. But you have enough money in your bank account using this model to do that, because we have that buffer. And then it comes positive and it gets up here to about $8,000 a month. What was the amount before? 20. Here's the difference. This is your cash flow when you don't hire a property manager. Here's your cash flow when you do hire a property manager. Pretty significant difference. 21,000 to whatever that is, 6 or 7. Difference if you adjust for inflation because it's 40 years in the future, it's like having $6,700 a month in positive cash flow versus having like just over $2,000 a month in positive cash flow. Okay. All right, so here's that chart where we show you the fees you're paying the property manager versus the cash flow you're getting on the property. It takes you a while to kind of break away from that right here. With the other property manager one, it takes a really long time. Basically, it doesn't happen until you're almost done in almost year 40. This is the cumulative amount. So you basically are paying your true cash flow. This is the amount of cash flow you have with your paying your property manager. This is the amount you have cash flow if you're not paying a property manager. And then this is the amount you're paying to your property manager cumulative over time. This is the account balances. So your account just starts growing over time and does this. We got a question?
Yeah, I wonder, you know, one of the things you said early on was that you didn't model in the tax savings on paying the property manager.
Correct.
Right. So I feel like that would decrease the delta slightly, but
slightly.
So I did the math. It's like 16. Like depending on what tax bracket you're in, right? If you save 80K across 40 years, and you're in the 20% tax bracket, it's 16K, and that difference was like 190K. So it's not huge.
It's small. You want to say the number again because you may or not been on mic.
Yeah. So the difference, like if it's 80K across 40 years, even in the 20% tax bracket, it's only $16,000, and the difference between those was like $193,000. So it's not. I thought it would be more significant too, and then I was like, oh, it's actually not. It makes a difference, no question.
Yeah, I don't think it's a huge difference though.
Yeah.
I think there are other bigger factors. Yeah. Okay, so total account balances. So this one is how much you have in your account at the end of the time period, 40 years. And you'll notice here, basically you have none because you're buying the property so late. Once you get to the point where you have $6,000 inflation adjusted plus your down payment amount, you're buying another property. It's going back down to that $6,000 inflation adjusted amount. Then eventually you're just kind of adding to it at the very end here once you get to month 400 plus. But the other one, you're done buying earlier. So you have more time for your money to start accumulating in your account. And so right here in month, whatever this is, 290 or so, you're done buying properties if you don't hire the property manager, and you're able to now start saving and having that compound. And remember, this is without any interest rate. This is like 0%. So if you had money in your account before, this gets even bigger because you're able to invest at 8% and start earning a return on it. Okay? So here's the total amount of equity. As you buy more properties, your equity is growing faster and faster, but there's a difference in equity. The interesting thing about equity is this. At some point, all 11 properties are completely paid off in both scenarios. So at some point, these converge back together and become identical again. There's only a period of time when they're apart and you're still actually paying off the properties, but realize you're buying 11 of the same property. And so they eventually get to the point where you have 11 of the exact same type of property no matter what scenario you are, and so the total amount of equity eventually grows back together and it's the exact same. Are we dead then? You're probably dead. It's actually not that. Yeah, I mean, yeah, for the other one, it's really long. It's probably like, yeah, Royce is probably like, exactly. Yeah. Yeah. Totally. That's probably true. All right, net worth. So here's a difference in net worth. Again, the one on top is the one you'd expect. It's over 10 million, probably 11 million or so, and then just over 7.5. Here's the difference, 11.7 versus 7.7, difference in net worth due in Nomad, hiring a property manager versus not hiring a property manager. So pretty big difference. I mean, before we were talking about almost $1 million if you do one. Now we're talking about 4 million. That's pretty significant. Again, though, you now have the time. You basically go buy the property. You can buy it with impunity knowing that you're going to have someone else handling the work for you on the back end, and all you got to do is manage the manager. So there's something to be said about that. If you adjust for inflation, 3.6 to 2.4, it's like 1.2 million or so is the difference there. And then what if we actually took any cash we got and we put it in the stock market at 8%, this is the kind of closeout of the presentation, and we were able to get an opportunity return on any extra cash we had there. Again, it speeds up the process. We could buy houses sooner. We get get a return on the cash we have sitting in the account, especially once we finish buying houses. And 8%, again, might be very optimistic. I think it is. And there may be additional risk of the stock market correction when we're about to buy our next property. So this is the plan from before, 0%. We had a property manager. This is how quickly we can buy the properties. If we actually go and we look at it, if you were earning 8%, but we were hiring a property manager, it shifts things over slightly to the left. So we can buy things a few months earlier if we're getting an 8% return on their money over time. So basically, it shows you the same exact chart, shift it over. If we're not hiring a property manager, though, it looks like this. Now we can actually do things much faster, and we're doing that. Now, what if we were able to get an 8% return when buying properties, and we're not hiring a property manager? It shifts it over again to the left. So it's what you'd expect. So true cash flow, this is the one where you're not getting any return, 0% with the property manager, shows you the cash flow over time. This is the one if you actually are getting 8% return, because you're able to buy them a little faster, it gets positive slightly quicker, and it actually ends up being a little bit more at the end. And this last little blip is you paying off another house. Okay? This is the one where you actually have 0% return, but you're not hiring a property manager at all. And then here's the one where you're able to get no property manager and you're getting an 8% return. It's a little bit better, a little bit faster. Okay? But there's a big difference between these two. This is the difference. True cash flow. You're talking 22,000, almost 23,000 versus 21,000. This is basically you not hiring a property manager. One's with 8%, one's not. And then this one is you hiring a property manager, getting 8%, not getting 8%. Does that make sense? Okay. This is it, inflation adjusted. So at the end, you're about $7,000 a month, inflation adjusted, getting 8%, not doing property manager. If you're getting 8%, it's about 3.4 per month in cash flow doing it the other way. Okay? Total account balances. This is you at 0%, how much money you have in your account. With you hiring a property manager, this is you getting 8% hiring a property manager, so it shifts it over to the left a little bit. You end up getting your account balance, and it ends up making a big difference over time, especially since you're getting an 8% return on that now. And then the other one, this one is you not hiring a property manager, not getting 8%, and then here it is, finally, you not hiring a property manager and you getting 8%. It's the most significant difference of them all. Here are the numbers, 4.5 million to 2 point something million, and then something under 1 million for each of those other ones. I'm not even going to read them. If you adjust for inflation, 1.3 to 750 or so, and then some other ones under 250 and under probably 200. Total equity, same idea. The green ones are the ones where you're not hiring a property manager. The red and the blue ones are ones where you are hiring a property manager. The one on top is the one you're getting 8% from. And then finally, net worth, same type of idea. Biggest net worth overall is the one where you're able to buy the properties faster, get better cash flow over time, and you're able to get an 8% return. And then basically this is you hiring a property manager where you get 8% return. And those are the final numbers for net worth. It's 14 million to 11 million or so difference in net worth between doing, being able to get your 8% return. So 8% actually has a pretty significant impact. Being able to reinvest that money has an impact on stuff, and the property management stuff is really significant, in my opinion. Okay? All right. So, in my opinion, it is better to do it if you have to hire a property manager than not to do it. So don't let this discourage you, because there is a cost to having the property manager, but you can do other stuff with your time. You can actually go earn more money. You can go find better deals. You can go out there and enjoy yourself. You could do lots of things with your time. You're paying for that privilege. But just realize what the cost of that privilege is and say, is this worth it for me? And if you're not going to have 40 years, I mean, we took it to an extreme tonight. If you're just doing this for 5 or 10 or 15 years and you're not doing it for that long, it's much less significant. Okay? It's still worth doing, better financially without property management fees, which I think should be obvious. It may not be practical with your time and your willingness to do the property management work. There are definitely people I know that they are not qualified to do property management. They should not do property management. They're only renting out their properties, once a year, once every 2 years, and really they're not up on the laws. They're not up on the screening process. They're not qualified. They haven't seen enough, and it's better to hire a professional to do that so you cut down on vacancy and things of that nature. All right, and that is it. Any questions? Yes. Microphone, please.
So, maybe two-part question, please.
Okay, part one.
So, if I'm getting this right, so no matter whether you have a property management company or not, out of the four values of buying property, cash flow is not going to be one of them on either one of them for the first 10 years.
It is hard to find positive cash flowing properties in our marketplace right now.
Is that what it is?
Especially where interest rates are.
Even with 20% down, you know.
Yeah, I mean, you know, Boulder, I talked to a real estate agent in Boulder, it's probably, I don't know, a year ago now, probably a little bit more than a year ago. And what he basically said to me is in Boulder, they're putting 25% down to buy properties with break-even cash flow. So we are heading toward Boulder. I mean, we're heading to the point where you have to put more than 20% down in order to just be break-even. You're not getting cash-on-cash return. Cash-on-cash return is zero. And so I think we're heading in that direction, especially as interest rates continue to climb, home prices have continued to gone up, and then rents are not going up quite as fast as home prices are and rents are. And so you have these kind of multiple compounding forces where it's becoming harder and harder to buy properties with positive cash flow from the very start. But there's other parts of the return, and cash on cash has never been the largest part of the return when you look at the kind of four quadrants. Right. You know, appreciation is close to 15% return on your money. The debt pay down is like 5.51 if you're putting 20% down on a 30-year loan. So between those two, you're getting almost a 20% return on your money, even if you ignore the depreciation and the cash flow side of the equation. So where else can you go and put your money and get 20%? Still is a pretty good investment.
That's really great if you're paying for the property in cash. Because you get
no, it's not, because you no longer get the debt pay down, and your appreciation rate is actually only 3% then. It's not compounded by your down payment, because we're talking about a return on the money you invested, not an overall return. So if it turns out that you're paying for the property in cash, your appreciation goes down to 3, which is what I was using for my assumption. Your debt pay down goes to 0. Your cash flow probably goes up to probably 4% or so, somewhere in that ballpark. Your cash on cash return becomes your cap rate because you're paying all cash for the property. So it's about 4% there. And your depreciation benefit you're getting probably, well, you're now got the whole thing, so it's probably close to, you know, almost 3% total for your depreciation benefit because you're paying all cash. So really between all of them, you're at 10. You know, you got 4% for your cash flow, 3% for appreciation, and maybe 3% for depreciation. And so that's about 10% return. Where if you leverage, you get it much better. Twice as much.
Part 2?
Yeah, part 2 of your question.
So it's something else that's ringing in my head, and it's kind of a personal thing. I mean, it's been ringing with me. In one of the other classes, did we not talk about rotation of properties every 7 or 8 years?
Yes, we did. We talked about the kind of the nastiness of capital expenses and how sometimes you may want to actually roll your portfolio and do lease option exits in order to sell your property so you don't get stuck with roofs and new kitchens and new bathrooms.
Yeah, I'm the extreme of that. All my properties are really old.
Yeah,
you know,
and so this particular model has you holding the properties for 40 years. So think in your mind of a 1970s-ish property, early 80s type property that has, you know, 80s kitchen, 80s bathroom, 80s carpet, 80s paint, 80s outside exterior, and realize that's what a 40-year-old property is going to look like 40 years today if you bought new ones now.
So the 10 properties that you say and then living in 11th, we're still rotating those properties.
In this example, we were not.
Yeah.
But I think that there's something to be said about doing that. Now, the downside of doing the rotation is you open up yourself to additional interest rate risk. If interest rates are actually going up over time and you're having to buy new properties, even if you're taking all of the money and reinvesting it into down payments so that you have pretty much the same economics, you still have an additional interest rate risk. So there's pros and cons to all this stuff. The good news is if you have interest rates that are going up and interest rates do go down later on, you can always do a refinance and improve your cash flow position by doing that too. Yeah, thank you. Is it muted?
So one of the things I've done for most of my properties is to go something in between the property manager and do it yourself.
Sure.
And that is the home warranty companies. And so you don't have the risk of the capital, you know, expenditures because they pay for it all, not the roof, but everything else inside, all the electric, all the gas. Plus you put that burden back on the tenant as, well, it rents faster. When I say I have a home warranty service, they're not going to think they're going to be waiting for me to show up. They know that everything's going to get fixed or replaced.
Yeah. That's super interesting. So I want to tell you, all this stuff I made tonight is based on the Nomad calculator, which allows us to do some really crazy, sophisticated modeling of entire portfolios.
Mm-hmm.
And so one of the things I will model, I'll add the feature, I will add paying home warranty fees in there and actually removing a percentage of CapEx to see if it actually ends up being advantageous over time. And I'm adding probably Monte Carlo simulations for Q2. So I'll be adding the ability to do Monte Carlo where roofs can go at almost any time, and it gets increasingly more likely that a roof will go, or hot water heater. And so I will model that to find out if that really is effective over a very large sample set. I don't know if it is or not. Part of it's going to be the difference in what you're paying in the actual CapEx to do all the repairs versus what it's costing you to buy 10 home warranties on 10 properties.
But those are the home warranties, you do pay per property. You can negotiate it down. I know this because I have like 20 properties and I do this.
Yeah.
And I take it off I get a lower insurance. When I say I have this and prove it.
Oh, that's
the
actually an interesting
insurance
part of the equation.
companies, State Farm and all of those companies will give you a discount. It actually, and then you get the tax benefit. It actually, I think I came out to, it cost me about $9 a month per property to have it. And I've
Like
had
net after all your
net.
benefits.
Yeah.
That's pretty interesting.
And
Tim,
I'll
would you
tell
make
you,
a
I
note of
have
that?
20 properties, and you can negotiate with all of these
Yeah.
guys what your fee is.
That becomes super interesting. I'm gonna model that. I don't know if it'll be like the next thing I model, because I'm definitely got a couple things ahead of that. But I will definitely model it, and email me if you haven't heard in like 3 months.
Can I tell you one other thing? And you put in your lease, and you can, met a lawyer, and you can put a thing in your lease saying that your tenant is responsible for that first $75 when they come out. That prevents them for every time something goes wrong, they want to call you every 13 seconds saying there's a problem.
That's pretty
So
interesting, too.
it becomes win-win, and marketing-wise, tenants love it because they're, we're worried about them, but they're worried about us too.
Yeah.
Saying you're not going to show, you're going to this. They have a warranty service.
That's super interesting. I will go ahead and model that. I'll do some I'll do some stress testing on that one. Any other questions?
So what was the original cash flow on this property?
It was negative.
How much? With no property management, how much?
Guess there were a lot of charts. It was negative $80 a month, including depreciation.
But you don't. Okay. So including depreciation.
Yes,
so
true cash flow.
So what's interesting, because you and I both know, like, what would be super interesting, and it might have been in the slide you skipped over at the end, is rent sensitivity on this.
Yes.
Right? Because you and I both know that once you hit threshold for rent, right, everything else is gravy.
Totally.
Right? And so if your rent actually on this property was $2,045 instead of $1,845, you may never go negative, and while the difference will still be there, it may look a lot more appealing.
Oh, you may never go negative. You probably won't go negative because your rent is up there, right? But if you truly model a 40-year scenario where you actually don't have a static 3% every year rent going up, there's some years where it stays the same, some years where it might go down, and you actually model that correctly, I have a feeling it's still going to be, there's still a difference, no matter which way you
No
look
doubt
at it.
there's
Yeah.
a difference. I think that it won't look, it'll be a difference, but it'll be they'll both be higher. Right?
No doubt. I think that's absolutely true.
So
and
it would be interesting to run rent sensitivity.
we
That's
definitely,
really
we
my
totally can do that. And I plan on doing Monte Carlo where we do a bunch of different rent stuff and things like that. The challenge is I can't continue to run amazing looking properties when clients are actively out looking at properties and this is what's available.
No, I get that. But what does it look like in a different market, right?
I think I can model that pretty well.
Right, and I know you can. Totally unrelated to that, right? As you go through this, right? There are other. This is a longer topic discussion, but like there are, and you touched on it for just a little bit, right? The downside to managing your own properties is that difference in cost. It may actually cost you a lot more than that difference if you suck at property management.
That's true.
Right? If you discriminate,
higher vacancy, lower rents.
If you discriminate and have a lawsuit or you lose the house, it could totally cost you way more than that difference.
That's
right?
also true.
You could actually be in the bankrupt category or the whatever, in jail category.
Yeah, someone else owns your properties.
Yeah. And so there's part of it with that, because where that came from was I'm looking at this and I'm thinking, okay, well, if you're going to not hire a property manager, what else can you do? Well, you might as well do your own maintenance, right? It's the same thing.
I did say that.
Right?
You're not supposed to do your maintenance for asset
but
protection reasons.
But
I
for
agree.
the same thing, for
They
asset
are.
protection, right?
They are.
Property management is very, and in all honesty, probably worse.
I think you're probably right.
Right?
It's one of the highest litigious, sued,
Yeah.
things you can do as a real estate agent.
And
You get sued
people
for
are
both sides
trying,
and-
in this case, people are actively trying, like there are agencies actively trying, hey, You know, I have somebody with an African American accent call you, you tell me it's not available for rent, and then I have the, you know, someone else call and you tell me it's available for rent, and you're like in trouble.
Yeah, I agree.
right? And people aren't actively like, hey, yo, I need a new water heater. I'm gonna see if it blows
Let
up.
me see if
right?
you solve this
That's not
incorrectly.
happening, right?
Let me
They're
trip
not
on this
doing
carpet.
that. Yeah, I mean, most decent people aren't doing that. So it's just, obviously you wouldn't eliminate the 10% from maintenance because some of it's just material costs.
Right.
But there's definitely a percentage of that you could totally eliminate by doing your own maintenance that would then improve this, right? So there's categories of stuff to look at when you think about this situation. It's not just, and I'm only saying this because don't look at this and just go, oh, hey, I can save, you know, X million dollars by not hiring a property management. There are downsides to not having someone who knows what they're doing.
Totally agree. And one of the interesting things, and one of the reasons why we did this, I think Munir has a question, by the way. The other interesting thing is when I look at, you know, you break down your cash flow and how it's calculated. Your gross rent's coming in, you have vacancy, you have maintenance, you have property management. Property management is one of the larger percentage numbers. Right. And it's one that you have a lot of control over. You know, the other ones, maintenance, you've got, it's something there. I mean, even it's not going to 0. It might go from 10 to 5 or 12 to 6 or whatever it is. But property management's one you could make go to 1, you know, with your costs. That's right. And so this is one of the ones that it was like a really prime class to be able to teach and say, here, you have a choice. This is some of the pros of actually paying for it, and this is what the results look like. And this is one where if you decide to do it yourself, these are the results, and it's really your decision as to whether or not you want to do it. And I personally hire property managers. So if that means anything to anybody, and I just did all the math. So
you guys both touched on this, but if the property managers are moderately competent,
that's a huge assumption, by the way.
But chances that because they do it on a daily basis, I mean, there are lots of things I do, and then I have to do them once every a year.
That's right.
And I'm relearning how to do that every time.
Yes.
So the one we touched on was vacancy.
Mm-hmm.
So if it's vacant for an extra half a month,
it's
that's another $4.
Yeah, I agree.
You know, if it's vacant for a month, that's 8%, which is the cost of your property manager.
Yeah.
You know, because you were, I don't know, you went on vacation, you missed something.
Yeah.
That's the other thing that I just wanted to mention. Last year, on 3 of my properties in the same week, something went wrong with the garage doors. The rest of the year, nothing wrong. I didn't have to go and I had to call the garage door guy 3 times in the same 2-week period. He said, what are you doing?
Yeah. It is. It's super crazy.
Water leaks.
Yeah. You need to talk into the mic if you could. Otherwise, people like you are going to complain that when you listen to the podcast, you can't hear the audience.
Sure. You know, one of the things that we talked about, how some people are more passive or avoid confrontation. I do think you cost yourself money by not being able to be assertive with your tenants.
Yep.
And so I have a property manager. It is much easier for me to lay it down on them and tell them, no, go do this and demand this from the tenants than it is for me to do the same thing to the tenants.
If nothing else, and I think you actually said this earlier, is this gives you the impetus to say, I am paying you a fee, and this is what the major cost is. So you need to actually perform and implement on my behalf because this is a non-trivial expense for me. So it kind of gives you the motivation to manage your property manager effectively. And you sleep better. Yep. And confidently. Absolutely. And go watch that class because basically the class was really good about how to do that. Any final questions? Did you guys like this class? I may never teach it again, but at least we've got it recorded and we've got it documented. And I'm going to write a small book on it. Was it worth kind of doing? Was it worth coming, Christoph? I dragged you out of your house for this. It was worth $1 million? All right. Awesome, guys. I appreciate it. Stick around for the class after class. Do some networking. I will see you all next time.